Right now, though, we're going to continue talking about QE2. Just minutes ago, Mike McKee explaining how the Fed's renewed quantitative easing strategy will work. Our next guest says QE2 will work best if stock prices are falling before the easing starts. Joining us now is Mark Dow, portfolio manager at Pharo Management. He's also a former economist at the IMF and the U.S. Treasury. Thanks for joining us, Mark.
Thanks.
Carol and I have been getting a flood of emails. I even got a letter in the actual mail. Remember the postal mail saying that this is a bad idea. It's just something that the Fed is doing for its member banks. It makes them money, but doesn't help unemployment. It doesn't help growth. Why is everyone so against it?
I think a lot of people have a hard time understanding the intricacies of the transmission mechanism of monetary policy. It's a complicated issue, and it's gotten much more complicated in a world that's as financial as ours and as globally intertwined as ours.
But even Ben Bernanke admits that this is a very new tool the Fed is using. It's also very difficult to quantify the results. I mean, he admits there are going to be unintended consequences.
There's no doubt about it. And more importantly, it's uncertain as to how well it will work. I personally don't think it will be that effective through the traditional transmission mechanism of monetary policy, which is lower interest rates, spurns investment, and consumption. That channel's pretty much broken because we're over leveraged. However, there is a psychological effect, and we saw it very strongly when the Fed announced QE this second time around in September. People take risk. A lot of traders are sitting around talking to each other saying, next 15% on the S&P, up or down? Most guys said up. They said, what about the next 5? I'm not sure, probably down. When the Fed came out with this, it gave psychological comfort to traders that were worried about the next 5% to go out and take risk. When they started to take risk and risky assets rose in price, it started to feed on itself. The psychology fed on itself. Under-positioned investors started to buy, and better risky assets helped thaw the capital markets.
I got to jump in because that's all right. The market impact, I get it, why we're seeing a lot of asset classes go up. But go back to corporate America. They're the healthiest they've ever been, but they're not feeling confident enough to take risks and go out there and maybe aggressively hire workers. They're not doing that. We're not seeing banks aggressively lend at this point, even though it's costing them nothing in terms of getting capital. So to me, it's not really doing what it's supposed to do.
No, well, the hope is that it might do something against what they see as a very small cost of downside. Now, a lot of people dispute that, and they think there might be a larger risk of inflation. The Fed doesn't see that, and in my opinion, I think the Fed is probably right. So they say very little risk of downside, very little fiscal support if things get ugly. Let's do whatever we can to put a floor into this economy, and let's hope that it works to some degree. They're not expecting a large coefficient on that, but they expect it to be positive.
Do we still need a floor, though, on the economy at this point? I mean, some of the numbers, the economic numbers are coming about. The housing data that we've seen this week, existing new home sales, they're better than expected. Some consumer confidence numbers. Do we still need that floor?
Yeah, I think we do. To the following extent, we're not quite at the point where the patient is able to walk on its own 2 feet, kind of out of the ICU, but we're not quite there. In what the phrase that they use in Washington is self-sustaining private sector demand. It's not quite there, and that needs to be supported a little bit more so we get to that point where it can be. And as you say, the unemployment is high. People are not lending. People are not borrowing, and that tells you we're not quite there yet. We're close, but we're not there.
You say you're not too concerned about the effects of quantitative easing on inflation, but of course it's inflation expectations that matter, right? What if bond investors are worried about QE2 plus QE1 equals massive inflation? We're seeing obviously a lot of commodity prices rise at an alarming rate. And the bond vigilantes come back and drive interest rates up. I mean, that would be a real problem for the U.S. economy, wouldn't it? For the Treasury, to say the least.
In theory, it would. In practice, I think the probability is quite low that this happens. I mean, if you remember, we've talked about this before. Markets are often wrong. If you remember, after Europe, they doubted the European package for a month or so before finally coming around to it.
But if they're wrong, Mark, if they're wrong and it still sends financing costs way the heck up, we're still in a world of hurt, right?
This is why it's not that likely to materialize, the high inflation scenario. The output gap is too large. And for that, the kind of inflation that you worry about when you're at the Fed is not oil prices going up, because as we saw in 2008, that's often speculative and will collapse on its own if there's not something fundamental behind it. What they're worried about is us growing at a rate that's faster than our potential growth rate. And since the output gap is large, it means we're far from that point. And when they see the output gap start to close, that will give them plenty of time to reel back in the liquidity.
We've got 30 seconds here, Mark. Could we get something from the Fed next week in terms of QE2 that's going to be so disappointing, not enough to do what you say, boost that psychological feeling, if you will?
Well, let me be clear. I'm not expecting a huge psychological boost. I think we've already had that. But what I'm saying, the Fed says upside downside, is better doing it than not. So I do think it's a little bit of an empty cartridge that they're firing. Nonetheless, there's always a chance that they will disappoint, particularly after the run that we've had. And as I say, if we have a sell-off in the next couple of days, or we consolidate in this period, it increases the probability that we have a positive response. Often we react to news as a function of how we go into it. If we go into it pessimistically, we often reverse. If we go into it optimistically, we often reverse.
Got to run. Hey, Mark, thank you as always. We love talking to you. Mark Dow, portfolio manager over at Pharo Management.